Welcome to Master Your Money and Mindset, the show where we break down financial concepts in a way that feel clear, empowering, and actually doable. As our year winds down, we are putting together a series of shows to help you with year-end planning. But of course, this time of year, people are so focused on holiday plans and New Year's resolutions. But this is also one of the most important windows for year-end tax planning. And that's what this show is all about. I know that that's not as sexy or fun as talking about your holiday festivities or what you want to get as a gift or what you want to give as a gift, but it is super, super important. In this show, we're going to show you how giving a little attention now can make a big difference when tax season arrives next year, which seems so far off, but will be here in certainly the blink of an eye. But how planning now can save you money, can save you stress, and can definitely save you a few unnecessary surprises. As always on this show, I am far from the expert. I always bring on really smart people that I get to have fun conversations with. So on this show today, I want to welcome back Jeremy Hus. Jeremy is a Vice-President of Financial Planning here at Barnum Financial Group. So welcome, Jeremy.
Thank you, Elizabeth. Thank you so much for having me back.
Oh, it's always such a pleasure to have you on. We have had some really fun conversations.
We have, absolutely.
Jeremy just hosted a client webinar just last week, right?
It was last week, yeah.
Yeah, we had more than a few hundred people interested and attend. So Jeremy did a really great job educating our client base on this topic. So he is fresh with all the knowledge that we need from him. But today, Jeremy and I are going to walk through the essential year-end tax checklist. And don't worry, it's not about memorizing tax code. It's just about knowing the key areas that matter and the simple steps you can take before December 31st that will help you out as we move into 2026. The goal of today's episode isn't to turn you into a tax expert. We hope not to bore you. I don't think we will because Jeremy is a really fun guy. But the goal of this episode is to help you understand the opportunities that are available to you, the decisions you can still make this year, and the conversations you may want to have with your financial advisor and or tax professional. And that reminds me, you should always work with a financial advisor and tax professional when it comes to any sort of tax decision.
I would add too, right? There's a lot of nuance to this stuff. So obviously can't go through every little minute detail. So it is certainly important.
We're going to skim the surface, but you always want to work with an expert. But by the end of this show, you should have a clear priority-driven checklist to help you wrap up the year feeling organized, intentional, and on top of your financial life. Okay, Jeremy, let's start with account contributions. So if people want to put their money to work before year end, what should they do? How should they look at that? Yeah,
so certainly to start, and I think that's kind of the first thing that people think of is getting your contributions in. So think first your employer-sponsored retirement plan. So your 401k, your 403b, your 457. Those contributions have to get in by December 31st. So they are payroll deducted. So you got a little bit of a small window to get those contributions in, but it is something that you want to look at. And obviously, you want to be forward-looking too, thinking about, hey, I didn't max out the contribution for this year. Well, let's start planning in January for 2026.
Can you do a bulk contribution? Like, let's say you weren't great about it all year.
So yeah, you can increase pay. It's through payroll. So sometimes you can go up to like 100% of payroll. So maybe your last couple of paychecks, you're not collecting if you're in a position to be able to do that. But it is payroll deducted. So it is going to be based off a percentage of whatever remaining income you have coming in for the year.
So if you could do that, great. Yeah. For folks who maybe can't catch up like that, you can make an adjustment for the next few weeks of the year.
Exactly.
But then, Jeremy, that's a good, it's a good thing to know going into 2026.
100%.
Right.
And again, when we think about tax planning too, it's, a lot of times just think about, well, we want to minimize taxes today, but we also want to think about future planning. So I think, again, even if you can't get everything done for 2025, this is a great opportunity to start thinking about 2026 as well.
How can, when you think about that, like, oh, I can only increase it by a little bit. Mm-hmm. Will that make a difference?
Absolutely. I mean, every little bit helps. So I think any contributions that you can make prior to year end, not only, retirement plan contributions are a double whammy. Number one, you're getting a tax deduction if you're doing a pre-tax 401k contribution, but also, and probably more importantly, you're also saving for your future. You're helping save for retirement, and even small contributions along the way have a really large compounding effect down the road.
Is that what a catch-up contribution is?
So the catch-up contributions are for people over the age of 50, where they can do an additional $7,500 for this year. So those numbers do change over the years, but for 2025, it's $7,500. And then there's this additional special catch-up contribution, which is kind of a wacky one. And I don't know how Congress carved this out, but if you turn 60, 61, 62, or 63 in 2025, you have the ability to turn that $7,500 catch-up contribution into $11,250. So again, just those 4 ages for whatever reason. But again, if you are impacted by that, definitely take advantage of it.
Okay. So I'm writing down account contributions, and I'm going to bring that right to my financial advisor and my accountant and say,
sure.
What do I need to do?
Yeah, absolutely. And that's 401k. With IRAs and HSAs, you have a little bit more of a window. Yeah. So you have until April 15th of next year to be able to do that. So that's one where, hey, maybe I missed out on the retirement plan contribution at work. Am I eligible for a traditional IRA contribution that will also reduce my taxable income? Okay. So that's something I'll take a look at as well.
Okay, beautiful. What about people who are self-employed?
Yeah, this is a great one. The first thing I would think of, if you have side hustle income, so maybe you're a W-2 employee, you work at an employer, they have a 401k, you're maxing out your 401k contribution. But if you do some side consulting income, really anything that's reported as a 1099, you have the ability to set up potentially your own retirement plan. So you can do that in addition to your 401k. So something as simple as what's called a SEP IRA, which essentially allows you to contribute 20% of your self-employment income to that type of plan. So that could be a good option there. There's a bunch of different options depending on what your income looks like. But definitely if you have some self-employment income, it's a great opportunity. Again, getting a tax deduction as well as saving for retirement, getting some additional dollars in. So I think that's a good option.
Most people, I don't know, but most people side hustle. Maybe they just look at it as extra money or vacation money. Right. They don't look at it as something that actually can get them to their retirement.
Yeah, absolutely. Yeah, absolutely. So, and obviously if that's your main form of income, there's more things that you could potentially look at. You could look at setting up a solo 401k. So your own 401k, if you're only employee, or if there's multiple employees, again, then you might look at a more broad-based plan. But there's so many different options available to self-employed individuals. So it's definitely something, if you haven't looked at, definitely want to take a look at.
Love it. Because I have a few things. I have a few things cooking.
I'm sure you do. I'm sure you do.
But I would, often think of yourself as like self-employed.
Right.
Like, I always work for Barnum, and I love that.
Right.
But you're right. You look at that income because in comparison to your annual salary, it's, with respect to me, it's not anything substantial, but it is substantial enough where if I banked
and some people have that. I'm just collecting income. Like I don't even necessarily have a name for my business, but if you fill out a Schedule C at the end of the year for your taxes, that you have self-employment income. So it's something to take a look at for sure.
That's great. We should rename that to side hustle income.
I like it.
Okay. Let's talk about deductions. So I heard, yes, I heard you explain this on the webinar. You defined it as standard versus itemized.
Yes. Yeah. So that's the name of the game, standard deduction versus itemized deduction. So basically you get the higher of the two. So if you don't have a bunch of itemized deductions, I'll kind of go through what those are in a second. Then you would take the standard. If your itemized deductions equal more than your standard, then you wouldn't take the standard. You're going to take the itemized deductions. So the most common itemized deductions are going to be mortgage interest, are going to be your charitable contributions, are going to be your property taxes, medical expenses. So if they exceed 7.5% of your adjusted gross income, you could potentially deduct medical expenses. So if you add up all those and they're higher than the standard deduction, then you're going to lean to itemize.
To do that.
What's changed for 2025, and a welcome change, especially for people in the Northeast, is the expansion of what we call state and local income taxes or state and local taxes. Sometimes that's referred to as the acronym SALT. So that was capped at $10,000 of deductions, which most people, between state income taxes and property taxes, everyone was capping out. Now that's been expanded to 40,000. So it gives the ability for people to deduct more of those expenses to potentially, again, reduce their taxable income.
In what situations, Jeremy, would itemized deductions beat out the standard deductions? And I know it's going to run the gamut. Like I know it depends. I totally get that answer. Yeah. But from what you see, can you generalize, like typically somebody who's maybe self-employed or?
Yeah. So it's going to be, I mean, I think your income's probably in like the few $100,000 range, because your state income taxes is also going to be dependent on what state you're in. So do you live in Connecticut versus Florida? Like Florida doesn't have income taxes, so that's not going to be an available deduction. Connecticut would be. Do you own your home? Again, property taxes would be bundled into that. Do you have a mortgage? Again, mortgage interest would be bundled into that. So if you're lower income, no mortgage, in a state with no income taxes, then I'm probably going to be taking the standard deduction there. And the vast majority of people, it was, I think, estimated around 90% of people take the standard deduction.
Got it.
I think that number will decrease a little bit this year with the expansion of the state and local taxes. So I think we'll see more people taking the itemized deduction, but it is something to take a look at. And it's good just to take inventory of, again, those charitable contributions. I know we just came off Giving Tuesday, right? So just tally up those charitable contributions, because those also add into as an itemized deduction.
Jeremy, where's the best place to look? Or is there a place to look? Like, I always just want like a list of things that are possible deductions. Like, like a list of what's available for HSA purchases. That I forget that I need it until I see it on the list. I'm like,
it's a robust list, by the way. The HSA one's a good one.
It is a good one. But do they have that for deductions?
There are. I mean, it's something you can definitely research, and there's a list of them. Again, I gave you the most common. It's charitable. It's the medical expenses over a certain threshold. It's those state and local taxes. I mean, those are the big ones. There used to be more, but with the passage of the Tax Cuts and Jobs Act in 2017, a lot of those got wiped away. So there's really only a handful left that are available as an itemized deduction.
What about so many people working from home these days? So with home offices.
What
is that?
So like? That's a good one. I'm asking for a friend. Yeah, I'm sure. So W-2 employee, there's not an ability to deduct those expenses. Now, if you're 1099 self-employed, that's where you get the kind of whole universe of things available to you, where you can take the home office deduction. Basically, it's a square foot. So it's a percentage of the home that you can actually deduct, which is kind of cool. Again, self-employed, you just have the ability, deduct software expenses, internet, you get into I'm going to deduct my lease payment. So that's where the self-employed is where you're able to deduct a lot of those. Unfortunately, for a W-2 employee, you kind of lose a lot of those.
That's what my accountant says every year. I always ask.
I wish I had some magic for you, Elizabeth. I really did, but
that's okay. Your answer matches up.
No, that's good. That's good.
I was just hoping
you got to keep me honest. Keep me honest. Yeah.
Oh, that's good. But again, that's something that people will go through with their accountant as far as which option is better for them.
For sure. Yeah, I think the idea is just make sure you keep an inventory of what you paid. So mortgage interest is relatively easy. You're going to get a 1098 at the end of the year. That's when
all the statements come flying.
Yeah, I know. Right? You're like, what am I supposed to do? Do I really need to keep this thing?
I put them all in a folder and then again, give them to the guy.
Yeah.
Okay.
Absolutely.
I heard you mention, Jeremy, tax loss harvesting. Tell me about that.
What does that mean? It sounds cool. I don't know. Yeah.
I did lose it during that part of your webinar.
Yeah. So the idea is if you have a taxable account, so say I own a couple stocks in my account. I own Apple and Google. And let's say one's up, one's down. So let's say, Apple's up, whatever, $10,000. Google's down $12,000. Well, I can sell both of those positions. And in that example, I'd have a net loss of $2,000. So I don't pay income taxes on that $10,000 gain because I have a loss to offset that. So even
though the loss is small.
Yeah. So it can be a 1-for-1. So I gave the loss in that example was $12,000. If it was at a $10,000 gain and $1,000 loss, it's going to reduce it. So then I'd only have a $9,000 gain.
Got it.
So it's a way to control your taxes. So it's looking at what opportunities you have within your investment portfolio and see, hey, there's some positions that have had a really good run. And obviously we've seen those, especially in the tech and AI space. Or do I have some losing positions where I have the ability to offset some of those gains? And just, again, it's really about a matter of trying to reduce your tax liability over time. The other cool thing that you can do, so let's say, give another example, let's say gain of 10,000, loss of 13,000. So I have $3,000 remaining. What's cool with that is I can take that $3,000 and offset it against ordinary income.
Oh.
And ordinary income tax rates are typically higher than capital gains rates. So it is a way to potentially reduce your ordinary income, which is a cool thing.
It's like, who knows that? Nobody would know. Like the average person doesn't know that.
You're right. Yeah, it is definitely a nuance. If your investment advisor, good ones will definitely on a taxable account. That's something that they're looking at. I mean, this is definitely the season for things like that. So they really should be diving into your portfolio. Hey, is there positions that we can trim in a very tax efficient way? So that's something I should definitely take a look at.
That was my point, is that like normal people don't know this.
Yeah,
so you have to work with somebody
for sure
who just knows that all these nuances, tax laws are in place. And it sounds like that's in place for us to take advantage of.
For sure. Absolutely.
Right. To kind of lessen that load a little bit.
Yeah, absolutely. And another nuance there too. And a lot of people say, I want to invest in like an index fund. So I'm going to invest in the S&P 500. But they don't realize if I have that in a taxable account, well, the S&P 500 is up pretty significantly year to date. But there's 40% of those companies are actually losers this year. So if you own those individual holdings rather than the index, you have the ability to, again, minimize your tax liability over time. So something really to take a look at, especially if you have a large taxable account, does it make sense to have individual holdings versus an index? It just gives you more control.
Definitely a question to ask.
Yeah, for sure.
Love that. How about minimum distributions? We hear a lot about that this time of year.
Yes, one of my favorites.
Yes.
So
that word is a flutter.
Yes, don't miss the window, right? So and it's been a moving target, right? We had minimum distributions that started at 70.5, 72. Now it's 73. So I can say everyone who's 73 today on this call needs to take a distribution from the retirement account. So this would be your 401k, your IRA. You need to be able to take those distributions. That first year, they do give you a little bit of a reprieve. So if you just turned 73 this year, you have until April 1st of next year to take your first distribution. And some people say, well, I'm going to kind of kick the can. I'll worry about it next year. You want to be careful. Yeah, you want to be careful doing that, because if you wait till April 1st to take your first distribution, well, you also have to take another one December 31st. So then next year I'm kind of compounding my tax problem if I don't need the income, right?
Also complicated.
Yeah, yes.
So complicated.
And that's with the owners, right? And then it gets even more complicated talking about beneficiaries, meaning if you inherited an IRA, the IRS has made and really Congress has made a complete mess of these rules, which is, I mean, it keeps me employed, I guess, which is, I'll take that.
But you know them.
But it is convoluted and probably outside the scope of this podcast. I will say, if you've inherited an account since 2020, there is a new change this year that goes into effect. If you have not taken a distribution from an account, take a look at it. You may have to take a distribution this year. So if the owner that you inherited from was taking required minimum distributions, meaning they were over, let's call it 73, you're going to have to take a distribution this year. And you probably you're not even aware of that because the laws have been kind of convoluted and Congress has been trying to figure it out. So again, if you inherited an account after 2020, definitely take a look at that and see if there's something you need to do.
Listen, folks, Jeremy's contact information is in our show notes. I can't repeat anything he said. I don't even know. But if you need to get in touch with Jeremy, his contact information is in our show notes. Because again, all these wonderful opportunities are here, but you need someone to teach you when to use them. Yeah. Why does that number keep changing? Like, why does
for
that
fun? Yeah, I don't know. For Congress gets bored sometimes, and like they just, I don't know. Yeah. And it's kind of a crazy one. Because it really doesn't benefit anyone, in my opinion, right?
And we're talking about the minimum distribution.
Yeah, so that age change, right? Because the reality is for lower income, lower net worth individuals, they're retired at 60, 65. They need that money. So the RMDs don't mean anything to them. And for wealthier individuals, from a planning perspective, it typically doesn't make sense for them to delay till 73, 75. You want to try to accelerate that income to minimize your tax liability over time. I have no idea. I don't know. I don't know why.
That makes me feel better.
I have no idea why they're so hung up on that number. But yeah, the reality is, and that's a key word too, is minimum. It's a minimum you need to take. Rarely in life do you ever want to do the minimum. So you really want to be proactive with your RMD planning, your required minimum distribution planning, to see when it makes sense. Because usually there's a nice window. You retire at 65. Well, I don't have to worry about RMDs until I'm 73. I have a nice window of potentially very low income where I might want to accelerate some of my distributions. And we'll probably talk about Roth conversions in a second, but that's a great opportunity to think about Roth conversions.
Okay. Before we get to Roth, I wanted to ask you about charitable giving.
Yeah.
Because that is always a hot topic as well.
Yeah, absolutely.
What do people need to know with that?
Yeah. So we talked about the charitable giving with your itemized deductions. Another thing to take advantage of if you're 70 and a half and older is what's called a qualified charitable distribution. So this allows you to take money directly from your IRA and give it right to charity. And the benefit of doing this, forget about that whole itemized stuff. You don't have to itemize deductions to take advantage of that. So I can give the money directly to charity. It doesn't hit your adjusted gross income at all. So for people that are retired, that's a big deal when we think about Medicare surcharges and how much you pay for Medicare, what your taxes look like, some of the credits and things like that you're eligible for. It's a very efficient way to give to charity. So I would say almost everyone, and it's rare that I can say something like that. If you're 70 and a half and older, your charitable giving should really be done from your IRA. It's a very efficient way to give to charity.
Okay. For the rest of us, we're truly just talking about any donations to a 501c3.
Correct. Yeah. And that's, again, to deduct that, you're going back to the itemized deduction world. So it's really those people 70 and a half and older that have this special thing that they can do directly from their IRA.
For the rest of us,
yeah.
What rough numbers, Jer? I'm a rough numbers type of girl. How much do you have to donate to see the impact?
Yeah.
Like in a deduction?
So that's a good question. So it's going to depend, going back to our previous point around the standard versus itemized. If before my charitable contributions, I'm already in the itemized world because of my mortgage interests and my property taxes and my state income taxes, then every dollar that you contribute is going to save you whatever your tax rate is. Let's say your tax rate's 32%. Every dollar that you contribute is going to save you 32 cents. So you're basically getting a third of that back plus state, right? So if you're in Connecticut, say it's 6%. So it's almost maybe 40 cents on the dollar that I'm getting back for contributions. If you're in the standard deduction world and I contribute $1,000, I still don't itemize my deductions, then it doesn't mean anything for you. So really, sorry to burst your bubble there, but it really,
true bubble burst on this call, Jer.
So it really depends on kind of where you fall in that, again, that realm standard versus itemized deduction.
Okay. Moving on.
Yeah, sorry. I feel like I'm doing a lot of soul crushing here today.
Okay.
I'm sorry.
That's okay. All right, let's get to the Roths.
Yes.
We're almost done. We're coming down to the end of your list. So let's get to the Roths because this is another one you hear about all the time.
Yes. So
what do we need to know?
Yeah. So this is really near and dear to my heart. This is Roth conversion season to me. I think this is a great opportunity. I kind of alluded to it previously for people that have lower income, whether you're just retired or maybe it's just a lower income year. Definitely take a look at it. I mean, I think so many people are focused on, I just want to reduce my tax liability now. And so I'm doing those pre-tax 401k contributions. I can't tell you how many clients that I've met with that are transitioning to retirement. They've kind of been do-it-yourselfers all this time. They look up, they're like hoping that they have enough for retirement. And then I do a financial plan for them and run out the projections. And their issue is not that they don't have enough money. They have too much money and it's in a taxable, it's all in tax deferred accounts. Their issue is income taxes down the road because their RMDs, when they kick in, are going to be $100,000 more than of income that they need. So it sounds good at first, like I have more income, but more income means more taxes. And we never want you to pay more taxes than you need to.
Yes.
So looking at that and this is where you really need to be proactive and look at that long-term view and say, is there a window now to start to accelerate income? And so with the way that a Roth conversion works is essentially I'm taking money from my traditional IRA, I'm paying taxes on it now. Why would I ever do that? Well, the reason is I'm stuffing it into a tax-free environment where I never pay income taxes on it ever again. And I'm never forced to take distributions on it during my lifetime.
Yep.
So it's a really efficient way to minimize tax liability, not only for you, but ultimately when you're thinking of, if you're going to have assets left over that are going to pass on to your children or loved ones, that's a great way to leave money behind. IRAs are really the worst way to leave money behind because of the tax issues and those complicated RMD rules. Roth IRAs are really the best way to leave assets because not only they receive tax free, but under current law, you can let them sit for 10 years, all 100% income tax free at the end of the 10th year. So they're great.
You're going to pay taxes.
Yes.
The question is, you're going to pay now or you're going to pay it later.
Exactly.
Tax rates or tax brackets typically don't go down.
Yes.
So most likely you're going to be paying more later.
Correct.
So you just got to bite the bullet now.
Yeah. Yeah, it's a good opportunity. Again, I know it doesn't feel like it for like a lot of people, but tax rates are actually has historic lows.
Yeah.
So we got a good window. I mean, again, you're looking at record-breaking budget deficits every single year, growing national debt. You can make a really strong argument that tax rates have to go up in the future. So again, let's hedge our bets a little bit. Let's try to accelerate some income, get some money into a Roth IRA. It's great planning. And again, I just think it's smart planning long-term.
Okay.
Done correctly, right? Yeah, there's definitely a lot of nuance there.
Work with your professional. Yeah. Jer, that was a strong list. We went through
we did rapid fire too.
We did,
good,
yes. We did do rapid fire of what everybody needs to just take a peek at, but most importantly, bring to your professional team.
Absolutely.
Jeremy, if you could leave our listening audience with one piece of advice when it comes to year-end planning.
Yeah, I think the biggest thing is be proactive.
Okay.
I think a lot of times it's like a task to be done at the end of the year, or sometimes we're looking at it in March that I need to give this stuff to my accountant. I encourage everyone, take the long view, like really look proactively, because it's not necessarily minimizing tax liability today. It's how do we minimize our tax liability over time? So really taking that strategic approach and really understanding how these things will impact your future, I think is extremely important.
Love that. So as always on the show, being proactive is always the way to go, and working with a professional.
Absolutely.
Jeremy, thank you so much for being on. Thank you so much for sharing your knowledge. I always appreciate having you on with me. But to everybody listening, thank you for joining. Listen to Jeremy's advice. Go down this checklist. As always, master your money and mindset, and we will see you next time.
Thank you so much.
Thank you for listening to Master Your Money and Mindset. You can find these episodes on YouTube or wherever you listen to your podcasts. Don't forget to like and subscribe if you enjoyed what you heard. You can follow Barnum Financial Group on LinkedIn and Instagram. Thanks so much.
All opinions expressed by the program participants are solely their current opinions and do not reflect the opinions their respective parent companies or affiliates or the companies with which the program participants are affiliated. Investments or strategies mentioned in this program may not be suitable for you, and you should make your own independent decision regarding them. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You should strongly consider seeking advice from your own investment advisor. Securities and investment advisory services offered through qualified registered representatives of MML Investor Services, LLC. Member SIPC, 6 Corporate Drive, Shelton, Connecticut, 06484, telephone number 203-513-6000.